Discuss with our guest, our panel today, and certainly we'll try and digest how it might affect the market as we move through the trading day. Chris Weston joins us from RG Markets in Melbourne. Also got Simon Mariner joining us from Aliom Financial at the Sydney CBD studio, and of course Carson Scott with me in studio. Yes, Simon Mariner from Aliom. What do all the numbers mean? Why do we care? What does it mean for the broader picture and for the picture of China as well?
Well, look, there's not a lot more to add to that. A good comprehensive coverage of that. The only one not mentioned, I suppose, in the production report was gold. There was a nice number in gold, although BHP not a massive producer of gold. Interestingly, we saw a good rally with BHP shares yesterday, the day before. So investors potentially expecting a good production report. Also potentially looking at China and seeing the Chinese growth story now, or if you like, the cooling off in China as the good kind of cooling off, and getting behind that. And we mentioned those macro headwinds as well. The resource tax, the super profits tax originally, would have meant that BHP internally would have put some stuff on hold here, maybe look to offshore operations. This is a big ship, a very big thing to turn around, and certainly, with potentially some of the relaxing in that tax, some of the reforms being positive, would they have had time to feed into these production numbers? I don't think so, but certainly investors still quite bullish on that stock and the outlook for China's sustained sort of growth over the longer term.
And yet it's sort of on that knife edge. I don't want to over-egg that one, Simon, but do you think investors would have been more comforted by BHP saying we are looking to lock in long-term price certainty? Instead, they came out and said most of these bulk commodities are being priced on the spot market, which has got all that uncertainty associated with it.
Yeah, I think so. I think there's certainly a bit of a playing cards close to their chest, because from an investor's perspective, looking at these mixed signals we're getting and these headwinds as we mentioned earlier, internally they've got the same difficulties in terms of their strategic planning and their forecasts and their forward looking as well. They're looking at what's going on in Europe and the US. They're looking at how that's going to impact China, who's a major buyer of theirs. Can China shift gears on their growth story to more of an internal focus and not relying on that export-driven demand, so that they're still going to increase their infrastructure, still going to build stuff, and certainly drag Australia along more in that Asian outlook rather than those other developed economies.
Chris, and to both of you, commodities got a bit of a kick along overnight. There was this speculation we mentioned just earlier in the show about the Fed may be stopping the payment of interest on reserves. The speculation has been just labelled speculation, but everyone wants to know what Ben Bernanke's got up his sleeve, and we continue to see weak data out of the United States. Simon, can I ask you, if we actually were to see that, and that was kind of something that they mentioned that they're going to be doing, how could that actually affect this China picture? And again, of course, how does that flow through to us in Australia?
Yeah, overall a very mixed signal out of the US last night. You mentioned that the weaker housing starts, lowest levels since October. Hard to draw conclusions there, I think, due to all the distortion still left to play out. On the other hand, we saw a positive signal from building permits, which is a little bit more forward-looking of potential sort of growth and recovery. And into that whole mix came these hints from the Federal Reserve that they're going to stop paying interest on the reserves. What does that mean? Well, there's pretty much an ocean of cash sitting with the Federal Reserve from banks earning a handsome rate of return, risk-free rate of return of 0.25%. If they stop paying that money's got to find its way somewhere. It's going to hit the streets. It's going to increase liquidity. It's going to increase liquidity or money supply in a good way. And what I mean by that is not printing money on the press, quantitative easing, which is potentially dangerous and damaging with inflationary implications further down the track. So the question is that, okay, all this liquidity, it's got to go somewhere. Where's there going to be the demand for it? And that's quite interesting. So we could see a little bit of foreign investment coming back into Australia. Pretty good interest rate differential right there. Nice ties to China. As I mentioned earlier, China's looking at showing the world, or investors are coming more to terms with the fact that the slowing in China is this good kind of slowing. They had some inflation data which was okay, so they're kind of over the hump for inflation, China, and it seems that they've touched the brakes just enough. And yeah, if they can get the mix right in between their internal and external focus, it will play out quite nicely. Not wanting to go too far ahead, we heard a little bit about that from the RBA as well, and some hints and some mentions for our own central bank as to the ramifications for monetary policy here, and whether we're looking at ourselves internally, Asia, or potentially what the US is doing.
And Simon, on Ben Bernanke's testimony in front of lawmakers this week, usually it seems the idea is to say as little as possible and add not a whole great deal. Do you think there will be some sort of hint of this change, I guess, or stopping the payment of the interest on those reserves?
Yeah, certainly the market investors will be hanging on every single word and trying to garner their own interpretation. We heard from our own central bank yesterday that was using or implying that they had the flexibility to pause in the face of global uncertainty. So you've got to work out for yourself what that actually means. I'm sure we'll hear the same from Bernanke tonight when he talks on monetary policy. Just one interesting measure. We've spoken a lot about sort of indicators and things like the Baltic Dry Index and other sort of price series. And as Chris was mentioning there, looking at getting some sort of trend. There is this interesting index by the Economic Cycle Research Institute in the US, which has an indicator that has predicted recession with 100% accuracy. It's got about 42 years worth of data. I think the market will be focusing quite closely on that. It's just dropped to a minus 9.8. If it hits minus 10, we're pretty much 100% likelihood for another recession there in the US. So until we start to see those sorts of things moving out of the woods, I don't think the markets or investors are going to get back into the market and insto players as well in a serious and determined way.
Now, final word to Simon Mariner. Simon, literally, we've just got to end this up now, but I want to get some final thoughts from you on the day ahead. What do we need to know as we move through the session today? What have we missed out? Not
much today. I think we're going to have to sort of wait and watch in the sidelines. We've got Westpac index at 10:30 this morning, but again, tonight it's really going to be about those mortgage applications and Bernanke's talk on monetary policy. So I think caution. We saw some good volumes on the market yesterday. Potentially not going to see so much of that today as people sort of sit in the sidelines and wait and see.
Great stuff. Thanks, guys. Simon Mariner from Aliom Financial and also Chris Weston from RG.